I'm 99 years old, and I once said something to a 25-year-old investor that brought tears to his eyes. He had saved $5,000 driving for Uber at night while finishing college. He sat across from me and asked, "Charlie, is it even worth investing such a small amount?" I looked him straight in the eye and told him, "Son, that $5,000 is worth more than my first billion." Before we go further, pause for a second. If you're watching this right now, make sure you subscribe to this channel. Turn on the bell notification and select the all option so you never miss any future Charlie Munger wisdom videos. These lessons are not theories. They are the compounded results of a lifetime of thinking, winning, and failing in markets most people never understand. And while you're here, leave a comment telling me where you're watching from. I like knowing where the next generation of rational investors is listening. Now, back to that young man. I told him that he had access to opportunities I would gladly pay $100 million to touch again, but I can't because I'm too big. He thought I was trying to be kind, offering encouragement to a kid with pocket change. I wasn't. I was telling him a mathematical truth that the entire investment industry tries to hide. Having a small amount of money to invest is the greatest advantage you will ever have in your life, and most people waste it. You see, when you have little, you can move in small spaces where giants cannot fit. You can hunt in valleys that the elephants of finance will never enter. You can buy what they ignore, enter deals they can't justify, and capitalize on inefficiencies too tiny to matter to a billionaire. But when you start copying what billionaires do, instead of studying what they did when they were small, you kill the compounding before it even starts. Let me tell you a story from 1963 that changed how I think about money forever. It was 2 a.m. when the phone rang. Al Marshall, a businessman I'd met at a golf tournament, was on the line. He sounded shaky, almost panicked, not from fear, but from excitement. He was calling from a hospital because he couldn't sleep. He'd just done the math and realized that our $1,000 investment in oil royalties was going to produce $40,000 in cash flow over the next year. $40,000 from $1,000. He said, "Charlie, I've worked 60-hour weeks my entire life trying to earn $40,000 a year. We made it in 18 months from a $1,000 check." He was trembling with joy. I told him to calm down and get some sleep, but I couldn't sleep either. Not because of greed, but because I had just seen proof of a truth that few ever grasp. Small money, placed wisely, in niches too narrow for the big players, can produce returns that are mathematically impossible for the rich. That $1,000 investment didn't stop at $40,000. 60 years later, it still pays me about $70,000 every single year. Do the math. Over $1 million of cumulative return from $1,000 put to work intelligently. And here's the irony that keeps me up at night now. I can never do that again. Not because such opportunities disappeared, but because I've become too large. Managing billions means I'm priced out of the best investments I ever made. That Uber driver with $5,000 still has that chance. He can find the cracks in the market where institutions can't reach. He still possesses the most powerful edge I lost 40 years ago. If he wastes it trying to mirror Berkshire Hathaway's portfolio, I told him I'd haunt him from my grave. So I say to you too, don't buy what we buy now. Study what we bought when we were tiny. Drop a comment right now with your city and exactly how much money you have available to invest, even if it's only $500, even $200, even $50. It doesn't matter. What matters is what you do with it. Promise yourself you'll listen carefully to every word that follows, because I'm going to reveal the 3 principles that produced 50% annual returns from amounts so small they're invisible next to my current net worth. And I'll explain why those same principles become impossible once your capital crosses a certain threshold. You might see a young man on the side of the road helping someone change a tire and think he's poor. He might end up richer than you in 20 years, not because he's smarter or luckier, but because he understood what to do with small money when it still had room to grow. There's a conspiracy of silence about this in the financial industry, and at 99, I'm too old and too independent to stay quiet about it any longer. Financial advisors and investment firms want you to believe that small amounts don't matter, that you need 10, 50, or 100,000 before you can really invest. They'll tell you to park your savings in low-yield accounts until you reach their minimum threshold. Why? Because they can't collect meaningful fees on $5,000. It's not profitable for them to help you while you're small, so they train you to wait, and in waiting, you lose the most powerful compounding years of your life. There's another reason they push that story. They themselves don't know how to invest small amounts profitably. Their infrastructure, their training, their models, all built for institutional scale. They operate in billions, so they literally cannot access the micro markets where small money thrives. They call those markets illiquid and too risky. I call them the birthplace of every real fortune. Here's the truth that made that young investor cry. Small amounts invested intelligently produce not just higher returns than large amounts. They produce returns that are mathematically impossible for large capital to achieve. Warren Buffett has said it many times. If he were managing $1 million instead of $100 billion, he could easily earn 50% per year. Not 5, not 10, 50. Why? Because he could play in those same hidden corners of the market that are now too small to move his needle. Opportunities don't disappear because markets change. They disappear because you get too big. Your small money is a ticket to a world I can no longer enter. You don't need opportunities that can absorb $100 million. You need ones that can absorb your 5,000. That simple shift changes everything about what's possible for you. When Berkshire Hathaway analyzes an investment today, we need something that can put $3 billion to work. That requirement eliminates 99.9% of businesses on Earth. We can only invest in massive companies, tracked by hundreds of analysts, and priced almost perfectly. But there are thousands of small businesses, local enterprises, special situations, and microcap companies that are invisible to institutions but wide open to you. That's your advantage. Imagine a manufacturing company in rural Pennsylvania worth $2 million, earning $300,000 a year, run by a 70-year-old owner, ready to retire. No debt, solid business, selling for 7 times earnings because nobody knows they exist. For someone with $50,000, it's a gold mine. For me, it's a rounding error. That's what I mean by being too big to win. Multiply that by thousands of similar cases, undervalued small companies, quiet real estate deals, private businesses with retiring owners, and you see the world the way a small investor should. It's a world of permanent inefficiencies that only you can access. That's not a poetic statement. It's mathematical reality. And it's why you must understand what I call hunting, where the elephants aren't. That is where this lesson begins. And if you stay with me for the next few parts, I will show you exactly how I turn small money into massive wealth using 3 simple, repeatable principles. Because your advantage is not in what you own, it's in what you can still access while you're small. Let me explain exactly what I mean when I say you must hunt where the elephants aren't. Back when I was managing small sums, $50,000, maybe $100,000 in total, I discovered something embarrassingly simple that most investors still don't do today. I would go to the public library and read through Moody's Industrial Manual, page by page, line by line, every single company listed in the United States. This was long before computers, before instant data, before Wall Street research reports, just paper, numbers, and patience. And buried in those dusty pages were companies so small that nobody cared to notice them. These were businesses with market values of $100,000, maybe $200,000. They were invisible to big money. Mutual funds couldn't touch them because they were too illiquid. Analysts ignored them because nobody would pay for research on companies that small. Institutional investors literally couldn't participate. The profits were too tiny to move their massive portfolios. But for someone with small capital and sharp eyes, those ignored corners of the market were treasure chests waiting to be opened. I found companies trading for less than the cash sitting in their bank accounts. No debt, no fancy story, just neglected value. I found others priced below the liquidation value of their inventory. Imagine buying an entire company for less than its receivables and inventory, minus liabilities. That's like buying $1 for 50 cents and getting change back. It wasn't speculation, it was arithmetic. And arithmetic doesn't lie. One of those companies manufactured parts for streetcars. When American cities began replacing streetcars with buses, everyone assumed the company was doomed. The stock crashed to $2 per share. The whole company was worth a mere $100,000. But when I opened Moody's and checked the balance sheet, I saw they had $120,000 in cash and marketable securities, plus a factory building worth another $50,000, owned free and clear. The math was absurd. I could buy the entire business for $100,000 and liquidate it for at least $170,000. That's a 70% profit, risk-free. Why didn't Goldman Sachs, Morgan Stanley, or some big institution buy it? Simple. The total potential profit was $70,000. That's less than what they spend on coffee in a quarter. They can't pay an analyst to look at a file that small. They're too large. But for me, putting in $10,000 and earning 70% in a year and a half was extraordinary. I repeated that same kind of investment 20 times over the next few years. Almost all of them worked. I was systematically compounding money at 40 to 50% annually while sleeping well at night. That's what it means to hunt where the elephants aren't. The elephants, the institutions, the funds, the massive corporations, they can't fit through the doorways of these small opportunities. They're too big. The openings are too narrow. But you, with your $5,000 or $10,000, can walk right through and collect what they can't touch. During those years, I found another small textile company being liquidated. The liquidation value was already clear, about $8 per share, yet the stock was trading at $5. The company had announced its plan to sell its assets, pay off debts, and distribute the remainder to shareholders within 6 months. It wasn't a rumor, it was written in filings. Buying at $5 guaranteed an $8 payout. That's a 60% return, practically risk-free, because the assets were already being sold. No mutual fund cared, no big investor bothered. The total company was worth just $2 million. Nothing to them, everything to me. I put $20,000 into it and walked away with $12,000 in profit 6 months later. And those weren't isolated miracles. I found holding companies whose underlying assets were worth more than the parent company's market cap. I bought them, waited, and watched them correct upward. Over and over again. This is why I laugh when I hear people talk about efficient markets. Markets are only efficient for elephants. For small investors, inefficiency is everywhere permanent, structural, and profitable. There are hundreds of small public companies right now with market values under $10 million. Many have positive cash flow, no debt, consistent profits, yet trade at 5 or 6 times earnings. They stay that way for years because no billion-dollar fund manager will touch something that tiny. That's your edge. That's your playground. But here's the problem. Even when small investors discover these opportunities, most of them still fail to make real money because they don't know how to swing big when it matters. They research for months, find something incredible, and then they put 2% of their portfolio into it. Why? Because someone told them to diversify. That word has ruined more small investors than bad luck ever did. Diversification is what institutions do to protect themselves from mistakes they can't afford to make. But if you're small and you actually know what you're doing, diversification just dilutes your brilliance. If you've done the homework and found a genuine opportunity, don't insult it by putting pocket change into it. Take a real swing. Let me tell you a story that shaped my entire philosophy about concentration. My mother's maternal grandfather was a farmer in Iowa during the 1800s. He came to America with nothing but grit and discipline. He worked his land, saved every cent, and paid close attention to everything happening around him: soil quality, water access, proximity to town, and the financial state of his neighbors. Every 10 or 15 years, when a financial panic hit, desperate farmers would sell their land at 20 or 30 cents on the dollar just to avoid foreclosure. My grandfather would step in with cash. But here's what's crucial. He didn't buy 10 different farms across the state. He bought one, maybe two, right next to his own land, ones he understood completely, that he could visit every day. He concentrated his entire capital in the best local opportunity he knew. Then he waited, sometimes 5 years, sometimes 10. But when prosperity returned, the land he bought at panic prices multiplied in value. He'd sell, hold the profits in cash, and wait for the next storm. Over his lifetime, he made maybe a dozen major investment decisions, that's all. a dozen moves in 80 years. And he died the richest man in his county, even though he'd never earned more than a farmer's income. The secret wasn't luck or speculation. It was concentration, patience, and discipline. He understood something modern investors have forgotten. You don't need 100 decisions to get rich. You need a few excellent ones, executed with conviction. Let's look at the math. Suppose you have $10,000. You find 5 great opportunities over 5 years and put $2,000 in each. 4 of them double, 1 fails. You end up with $16,000. That's a decent 10% annual return, but it won't change your life. Now imagine you concentrated half your capital, $5,000, in your single best opportunity, the one you understand most deeply. It doubles. You now have $15,000 from that one move. You wait, study, and do it again. Over 10 years, repeating that process a few times, you can reach returns that diversification could never touch. The fear, of course, is what if I'm wrong? What if that one big bet fails? Well, first, you shouldn't be betting without understanding. You earn the right to concentrate by doing real work. I'm not talking about throwing darts at crypto charts. I'm talking about studying a business so thoroughly that you could run it yourself, understanding the management, the competition, the risks, and still seeing a margin of safety. When you reach that level of knowledge, concentration isn't gambling. It's rational. Even if you lose occasionally, the math still favors you. 5 concentrated bets where 3 double, 1 gains 50%, and 1 fails, still crushes the results of a diversified portfolio of mediocre ideas. That's how fortunes are built, not by spreading thin, but by going deep. It's how Buffett and I made ours. We weren't interested in being average. We wanted to be right big. And this brings us to one of the most powerful real-world examples of concentration ever executed: Warren Buffett's investment in American Express during the salad oil scandal. Everyone else was panicking. He did the work. He walked into restaurants, asked if customers were still paying with Amex cards. They were. He checked travel agencies. People were still buying travelers' checks. The business was intact. Only perception had collapsed. Warren then put 40% of his entire partnership capital into American Express. Not 4%, 40. Because when you know you're right, size matters. Within 2 years, the stock recovered completely, and that single decision changed his entire financial trajectory. If he had diversified instead of concentrating, nobody would remember that trade today. That is the difference between investors who build empires and those who build excuses. The American Express story remains one of the most beautiful demonstrations of what I mean by betting big when you know you're right. In the mid-1960 seconds, the company was caught in what became known as the salad oil scandal. A fraudster had filled tanks with water instead of salad oil, sold the same inventory receipts to different lenders, and when the scheme collapsed, American Express found itself on the hook for millions. The stock price fell like a stone. Wall Street declared the company finished. But Warren didn't panic. He didn't follow the herd. He went out into the real world and asked the only question that mattered. Is the core business broken or just the perception? He walked into restaurants, checked whether people were still using American Express cards. They were. He called travel agencies to see if they were still selling travelers' checks. They were. He saw that the scandal, while messy, hadn't touched the real engine of the company's value. So, while everyone else was running away, he ran in. He invested 40% of his entire partnership's capital into American Express. Think about that. Almost half his entire net worth in one decision. Most investors would call that reckless. But it wasn't recklessness, it was clarity. He understood the business better than anyone else at that moment, and the price was absurdly cheap. Within 2 years, American Express recovered, and that single decision propelled Buffett's reputation and fortune to a new level. If he had diversified, if he had sprinkled 2% here and 3% there, it would have made no difference in his life. But by focusing, he changed his trajectory. That's the power of a concentrated mind and a rational temperament. Now this brings us to the third great principle, the one that ties everything together. Don't be afraid of a concentrated portfolio. Diversification has its place, but not where small investors live. The entire gospel of diversification is built to protect people who already have massive wealth, not to build it from scratch. If you have $10,000 and you buy 30 different stocks, you're not investing, you're collecting. You'll have $300 in each position. Even if one triples, you'll make $600. That won't change your life. That's not how wealth is built. Most people think spreading their money thin keeps them safe. But what it really does is guarantee mediocrity. It ensures that nothing you own can ever make a meaningful difference. I call that diversification, spreading ignorance across too many places you don't understand. Let me tell you about a man who proved this idea brilliantly. His name was John Arrillaga, a real estate investor from California. He wasn't famous, didn't manage other people's money, and didn't chase headlines. Yet he became a billionaire through one of the most concentrated investment philosophies I've ever seen. When John was in his 20s, he made a decision that most people would call crazy. He decided he would only buy real estate within 1 mile of Stanford University in Palo Alto. That was his entire universe, 1 mile. No diversification into San Francisco or Los Angeles. No expansion into office towers or distant suburbs. Just properties inside that tiny circle. He spent 40 years doing exactly 2 things. When the California real estate market crashed and everyone was terrified, he bought within that circle. When the market became euphoric and prices went wild, he sold within that same circle. He didn't borrow recklessly, didn't chase hot trends, didn't diversify for safety. He just focused, bought cheap, sold dear, and repeated the cycle over decades. He knew that 1 mile better than anyone else on earth. He knew every property owner, every rental rate, every zoning rule, every future construction plan. He knew when Stanford was going to expand, when roads would be built, when schools would shift. He built such a deep information advantage that nobody could compete with him in that geography. That focus, that extreme concentration made him a billionaire. Now think about the irony. By modern standards, he was undiversified. Every financial advisor would have told him to spread out, to buy in different cities, to hedge his risks. But his risk was actually lower than theirs. Why? Because he understood every inch of his circle. He wasn't betting on random chance. He was betting on knowledge. True safety doesn't come from spreading your money across things you don't understand. It comes from understanding deeply what you're investing in. That's the real lesson of concentration. When you go deep, not wide, you develop a kind of insight that protects you better than any diversification formula ever will. Let's now connect this to a practical system you can start using today, no matter how much money you have. You can start with $1,000, $5,000, or $10,000. The number doesn't matter. The principles do. Step 1, choose your domain. Don't try to be an expert in everything. That's what fools do. Choose one specific area where you can become genuinely world-class. Make it narrow enough that mastery is possible. Maybe it's local real estate in your town. Maybe it's small software companies under 50 million in revenue. Maybe it's small manufacturing businesses, niche online stores, or dividend-paying microcap stocks. The point is to find an arena small enough that you can become the smartest person you personally know in that space. That's the first real advantage of small money. You can pick your battlefield. Big funds don't have that freedom. They're forced to play in giant markets. You can go where they can't. Step 2, dedicate time to mastery. Spend at least a year studying your chosen area, like a fanatic. Read every report, every article, every annual statement. Talk to people in that business. Visit locations. Understand pricing, costs, margins, competition, and cycles. Build a mental database so detailed that when an opportunity appears, you can recognize it instantly. This is the boring part, the grind, that most people skip. They'd rather chase shiny trends than dig trenches of knowledge. But the compounding of understanding is just as real as compounding money. Knowledge compounds too. The more you know about a narrow subject, the faster you recognize what everyone else misses. That's what I did, reading Moody's page by page. I built a map in my mind of every company worth knowing, every balance sheet pattern, every clue that pointed to mispricing. Warren Buffett did the same thing. He read every single page of Moody's manual twice. That boring, methodical work is what separates 50% returns from 5% returns. Step 3, wait. Wait for the right pitch. Once you know your field, you'll see hundreds of almost good opportunities. Ignore them. You only swing when the pitch is perfect, when the numbers scream value, when the risks are clear, and when you understand why it's mispriced. Most people fail here because they can't wait. They want constant action. They think investing means always being busy. It doesn't. Investing is mostly waiting. My advice to that young Uber driver was simple. Keep your $5,000 in treasury bills, earning safe interest until you find one perfect opportunity, not 5 average ones, not 10 maybes, one perfect one. And when you find it, swing hard. That's step 4, bet meaningfully. When you finally see that opportunity, don't nibble bite. Put 25 to 50% of your available capital into it. That's the difference between a small win and a life-changing outcome. Your friends will say you're crazy. Your family will tell you to diversify. Ignore them. If you've done the work, if you truly understand the investment better than anyone else, this isn't gambling, it's logic. The biggest fortunes in history were built by people who recognized their moment and went all in when it counted. You don't get rich by spreading thin. You get rich by hitting hard when your pitch comes. Finally, step 5, be patient. Once you've made your move, stop watching the ticker. Stop checking prices every morning. Let time do the work. The compounding of value takes years, sometimes decades. I've held investments for 60 years. My oil royalty from that $1,000 bet still pays me $70,000 a year. That's what patience does. The disease of our age is impatience. People want fast profits, constant dopamine hits, instant feedback. But that's not how wealth grows. True investing is the art of sitting still when everyone else is restless. If you can master these 5 steps, choose your domain, learn it deeply, wait for perfection, bet big, and hold long, you'll achieve something rare. You'll turn small money into great wealth without ever needing luck or a lottery ticket. The irony of all this is simple. People think they need millions to start, but the truth is the opposite. The smaller you are, the more powerful you are because you can move where big money can't. Your smallness is your advantage. Don't waste it pretending to be big. Patience, discipline, and deep understanding, those are the invisible levers that separate the few who build fortunes from the many who just dream about them. Most people think investing is about chasing returns. It isn't. It's about mastering yourself. Your temperament is more important than your intelligence. Your ability to sit still, ignore noise, and think independently is what compounds over decades. I've said this for years. The stock market is a device for transferring money from the impatient to the patient. When you've done your work and found something truly valuable, you don't need to babysit it. You need to let time magnify it. That's what most can't do. They confuse movement with progress. They sell. After a 20% rise, patting themselves on the back, not realizing they just cut down a tree that could have produced fruit for a lifetime. True investors don't get excited about quick wins. They get excited about the quiet compounding that happens in silence. Let me give you an image. Imagine planting a tree. You water it, tend to it, and wait. For years, it barely grows. People laugh at you. They say it's too slow, too small. But a decade later, that same tree is shading your entire house while they're still planting new seeds every spring. That's the difference between activity and mastery. Most people keep starting over because they can't bear to wait long enough to win. This lesson applies to everything, not just stocks or real estate, but businesses, careers, and personal finance. The longer your time horizon, the larger your advantage. Everyone wants to get rich fast. But the irony is that compounding only works when you give it time. The fastest way to get rich is to go slow with discipline. That's why I've spent decades warning people about the modern obsession with checking prices every morning, checking the news every hour, checking social media every 10 minutes. It's a form of financial self-destruction. The world rewards those who can delay gratification, not those who need constant confirmation. If you've bought quality, if you've done your homework, stop checking. Let time do its quiet magic. You'll be shocked by how wealth seems to grow suddenly after years of nothing happening. It's never sudden. It's compound interest catching up. As Buffett likes to say, someone's sitting in the shade today because someone planted a tree a long time ago. Now, here's the truth people don't like hearing. Your biggest enemy in investing isn't the market, it's yourself. It's your emotions, greed during booms, and fear during crashes. You'll watch other people make quick money, and you'll feel like you're missing out. Then, when panic hits, you'll want to sell everything just to protect yourself. Both instincts are wrong. Both destroy compounding. When you see everyone rushing in, step back. When everyone's terrified, look closer. That's how you find value. It's not about timing the market, it's about maintaining a rational mind when others lose theirs. Most people don't fail because of lack of knowledge. They fail because of lack of temperament. Remember this, an investor who knows less but behaves rationally will outperform the genius who can't control his emotions. That's why my rules are boring. Read, think, wait. Act decisively when the odds are in your favor. Then wait again. That's all. No fancy formulas, no secret algorithms, just discipline, patience, and judgment. When I was young, I saw people destroy themselves chasing excitement. They traded daily, bragged about profits, and vanished when losses came. The ones who lasted weren't the flashiest. They were the quiet, consistent plodders. They understood that compounding is a law of nature. It doesn't reward intensity, it rewards consistency. Let's go back to that young Uber driver. I told him something he'll probably remember long after I'm gone. Son, I said, your $5,000 today is more powerful than my $5 billion. Because your money can still slip into the cracks of opportunity that I can't reach anymore. I've become too big to win small. He didn't understand it at first, but when he did, he cried. Not from sadness, from realization.